What's up guys, welcome back to another video. We're going to be explaining exactly what the difference is between external and internal liquidity, how you can spot it and use it to your advantage when marking out your draw on liquidity. Let's get into the video. It's a lot of liquidity. So diving into it, we're going to be going over some plays and then actually marking out where external and internal liquidity come into play. So today, July 31st, 2026, we had 9:30 open at around here on the 1 minute. As you can see, we just start pumping up, but there is a reason we are actually pumping up. So as you can see here, switching to the 1 hour, this was that 9 a.m. candle. And if you see its wick, it was a huge wick, a seek and destroy wick. But there is a main reason. Marked over to the left, we have this giant fair value gap. Not a breakaway gap, because breakaway gaps tend to be smaller and tend to be a bunch of repeated fair value gaps. But as you can see, we have a giant fair value gap on the 1 hour. On the 2 hour, it probably combines into one, but on the 1 hour, it's a perfect example. This is our draw on liquidity, or our internal liquidity. Simply because a fair value gap is an inefficiency in the market where there was so much orders, so much volume that the market couldn't possibly fill everyone with their market and limit orders. So the market has to go back to fill them. That being said, we were coming up into this gap. This 9 a.m. wick right here ended up extending so much, but the key note here is that when it closed under 50% of the consummate encroachment of this fair value gap, signifying a very bearish movement. So back down to the 1 minute, of course, with the draw of that 1 hour fair value gap, we're also going to have prior session highs and lows. In this sense, we're going to use prior session highs. We're going to have London high, which is at 5:10 a.m. Then we're going to have early New York high, which is around 7 a.m. And then we have this significant high, which is within this fair value gap, which actually used at this point in time to reverse and go lower as a retest. But then this actually becomes our high to target later on. So before market open around the 8 o'clocks, we have a bunch of consolidation, creating a fair value gap right here, pretty big fair value gap. Now, what's normal with fair value gaps is often, most than not, they are going to get retested to fill inefficiencies, which is exactly what happened here. We go ahead, we retested the fair value gap. We actually ended up filling it, but notice how it's very important we didn't close below it, signifying that this is still bullish order flow. While we're retesting it, we create this little fair value gap right here. And then when we actually get out of it, we create this giant candle that actually ends up inversing this fair value gap, giving us this bullish order flow. Now, what is the main target with this order flow? It's going to be internal liquidity on a higher time frame, targeting the 1 hour fair value gap. And then it's going to be external liquidity on a lower time frame, targeting prior session highs. We ran this buy side, we ran this buy side, and we ran the other buy side. That means all external buy side liquidity has been hit, and the market likes to ping pong, as you can tell. So keep in mind, we have this 1 hour fair value gap that we just completely filled, but still managed to close inside. So now, considering that we have swept all internal and external liquidity, it is time for the market to pin a reversal. This reversal ends up triggering my personal entry and inversion fair value gap. That allows me to get in the trade and target a 2R. As you can see at the blue arrow, there is a bunch of consolidation, a bunch of stop losses, a bunch of liquidity, a pool of liquidity where I'm going to target using my entry model. That in a sense will be my external liquidity draw. Later on, the day proceeds and we end up consolidating for quite a bit, but in that consolidation, we end up forming relative equal highs. Relative equal highs are one of the strongest forms of market draws on liquidity, simply because there are so many stop losses there from people who trade support and resistance levels and trendline liquidity. The key point is there's so much liquidity there, it's almost impossible to not target. And as you can see here, after having a changes to the delivery, after inversing a fair value gap, and specifically after retesting a smaller fair value gap, we end up getting a reversal targeting those relative equal highs, and we end up pumping the rest of the day later, which is out of our trading session. So as you can see here, this is one of the examples of internal liquidity, which can be literally a fair value gap that has orders that haven't been filled yet. So this is one example. There can be many, like a change in state of delivery or an internal swing low. And then for the last example, kind of covering everything, I'll explain to you everything all in one kind of picture. As you can see here, we have our external liquidity, which are going to be a quadruple high. In other words, relative equal highs. Any relative equal high of 2 or more is honestly a great draw on liquidity. After forming these relative equal highs, we're going to come down, create this significant high, the swing high, and I'll tell you why it's significant. But we're going to come down even lower, and we're actually going to sweep this internal swing low. Not just fair value gaps are forms of internal liquidity, it can be this as well. Internal swing lows, which act as a great magnet. Now, after making this liquidity sweep, we're going to come back up and then come back down. Very important, how you notice we're not coming back down here to make another new low. We're actually staying probably within a fair value gap right here. Then for the sake of this example, after having a liquidity sweep on internal liquidity at the swing low, we're going to inverse a fair value gap for the sake of this example, creating another form of entry model for me, allowing me to catch this wave up towards these draws on these equal highs, also confirming a change in state of delivery, because obviously assuming this not being aligned, their candles, we're going to close above this high, confirming a change in state of delivery to external liquidity being right here. But this pretty much marks everything, guys, on what exactly internal and external liquidity is. These concepts are extremely important to understand where the market is going and why it is going there. A car cannot drive without gas, and that's exactly what liquidity is for the market. If you guys want more videos covering entry models, put it down in the comments. And apart from that, take care, happy trading, and as always, please use risk management. God bless.